So today we're going to look at General Mills' income statement, their balance sheet, and their cash flow statement, just to get a general idea and to work on the vocabulary. There's a lot of vocabulary when you're first starting. And so we're just going to start using the vocabulary a little bit. And so let's start with the income statement. So let's look at the top here. How do I know this is the income statement? Because it doesn't say income statement. It says consolidated statement of earnings. So earnings and income and profit are used interchangeably, so they decided to call their income statement statement of earnings. We know it's an income statement because it starts with sales and it lists out expenses and comes down to profit, which they're calling net earnings. Some people call it net profit, some call it net income. Those three words again being used interchangeably. So let's just read the income statement. It starts with sales, so these are what they've sold to customers during the period, so 14,880.2 in the year 2011. And then they've got cost of sales. We were calling it cost of goods sold, same thing. So this is the cost of the inventory that they sold during 2011. Then we have the rest of their operating expenses, their selling expenses, their general expenses, which would be like corporate expenses, administrative expenses, so the cost of their IT, the cost of their tax returns, all the general cost of running the business, not the inventory, but the others. They have two special things that we would talk about in a more advanced class, so we're not going to get into those. But the sales less the expenses would get you down to operating profit. So this is the profit due to the main part of the business, the transactions with customers. They have some interest expense here, which then reduces it down to this subtotal, income before taxes, and joint ventures. Well, joint ventures is something you would talk about in a more advanced class. But here's the income taxes, so then they would also have these joint ventures, which would be in the math. And get down to net earnings attributable to the full firm, but they back a little bit of the earnings out because they have a minority owner that gets those earnings. So the net income that General Mills gets to keep is this 1798. So that's their income statement. That's the profit that they made. On the face of the income statement, they would also show the earnings per share that this net income reveals. So let's look at the balance sheet. And if you'd like to look at these, by the way, you can just go to General Mills' website and look under Investor Relations and then under Reports. This is 2011. You could see something more recent if you wanted to. And you can do that for any public company. They all post their annual reports under Investor Relations on their websites. It makes it easy for you to go and look at any company that you may be interested in. All right, so at the balance sheet here, notice the balance sheet here is at a certain date. The income statement was for the whole year, for the whole fiscal year. They don't have a December 31st year end. Their year end is May 29th, or I guess usually the last weekend in the month. It's a fiscal year rather than a calendar year. But this is the last day of the year for 2011, May 29th. So this is the cash on that day. This is what they were owed from customers. This is accounts receivable. This is what customers hadn't yet paid them for things that were sold. Here's the inventories that they had on hand on that day, not the day before, not the day after, but just on that particular day. They had some deferred income taxes, which is something you would talk about in a more advanced accounting class. They prepaid some things. We'll be talking about prepaids in about 2 or 3 more chapters. But prepaids are things you've paid in advance that haven't been used up, such as an insurance policy, or a insurance policy on a truck where you have to pay for the whole year in advance. And so anything that had not any policy period that hadn't lapsed by May 29th would still be reported here. And then those are subtotaled. These current assets are added, and this is the subtotal. And then the non-current assets, land, building, and equipment, goodwill, which we'll talk about in a later chapter, other intangibles, which we'll talk about in a later chapter, and then other assets that they don't identify. So these all add up to be the total assets for General Mills. And that has to equal their liabilities plus equity. So let's scroll down here and look at their liabilities. They have accounts payable. This is what they owe vendors. They have the current portion of long-term debt. So this is the portion of long-term debt that will be repaid in the upcoming year. They have notes payable. So these are short-term debt that they will be repaying in the next year, and other current liabilities that they don't identify. So these add up to be their current liabilities. And then their long-term liabilities, these are liabilities that will be paid later, 2 or more years from now. Deferred income taxes, which we would talk about in a more advanced accounting class, and other liabilities that they don't list out individually. And so they end up with this $12,000 in total liabilities. And then they have their equity accounts. So they have what they've gotten from owners, which is the first 2 amounts, and we'll talk about that, why they're broken into the 2 amounts in a later chapter. And then the retained earnings. Here's retained earnings. So this is all of the income that they've made since General Mills ever started, less any dividends that were paid out to owners. So these are the earnings retained. They've got some other accounts here that we'll talk about in more detail about how they change total equity in our equity chapter, which will be later in the course. So then here's total equity. So liabilities plus equity equal to 18,674, which matches total assets, which is correct. The balance sheet always has to balance. So before we get to the cash flow statement, we're just noticing here that General Mills, their 4th formal financial statement, is the statement of changes in equity and comprehensive income. What this does is show the beginning balance in all of the equity accounts and details out line by line what made it change. So let's just look at retained earnings for fun. Here's the beginning balance for retained earnings in 2008. It went up by the income they made in 2008 and down by the dividends they paid in 2008, giving you the ending balance and the beginning balance for the next year. And then it goes up by profit for that year and down by dividends, gives you the new balance. Then up by profit, down by dividends, and gives you the new balance in retained earnings. So that's what we've been learning, is what makes retained earnings go up and what makes retained earnings go down. All right, and here is their cash flow statement. So their cash flow from operating activities, they start with net income, and they reconcile all the things that were in net income that weren't in cash to get you down to the cash that was provided from operating activities, and we'll have a whole chapter on that later in the course. So the cash that they got differed from the income on the income statement. And that doesn't surprise us, because we know there are transactions that occur that are captured on the income statement when you sell to a customer that may not have been collected yet, so they couldn't be on the cash flow statement until they're collected. We see that they have some investing activities. They bought some long-term assets, land, building, and equipment. They bought some investments, acquisitions, other firms. They also sold off some things. And so those long-term assets and investments net down to using cash. So so that's the brackets is a negative number. That's the custom for accounting, is to show negative in brackets. And then you've got the cash flow from financing activities. So that would be getting and repaying debt and transactions with owners. So they did get some debt, and they did repay some debt. And then they did have some activity with owners. They got dividends paid here, so you can see that, as well as seeing that it impacted the retained earnings. So let's see their cash and cash equivalents at the end of the year, beginning of the year. Their increase, it's hard to read, there's so many numbers on the page. They had a decrease, so the cash went down during the period because the cash outflows were bigger than the cash inflows. After the 4 formal financial statements are the footnotes, and the footnotes explain in greater detail some of the bigger or more complex balances that are shown. So at the bottom of each of the income statements, you always see this "see accompanying notes to consolidated financial statements," where you'll see more details about, for instance, what's in the long-term debt. So there would be a footnote that would list out all the loans and the interest rates and details about what's in that 311. So that'll give you a general idea of how to read and how to start looking at financial statements. And what I wanted to show you was right before the income statement, or right after the income statement, you'll have the auditor's report, which indicates that the financial statements were reviewed by somebody who's unbiased, an outside auditor. So you can have some fun. Go look at some financial statements for firms that you're interested in and see if you can't start reading it and practice with the vocabulary.